taking care of mutual fund product at HDFC Securities. So today we'll be discussing on an interesting topic, that is economy and earning. So as you all are aware that, from quarter two result onwards, the market started to taking a U-turn, and last 3 months has been very volatile. And we have the quarter three result earnings flowing in. So, how does it pan out, and how the result has been of some of the large companies who have given the result, and to help us understand how the economy is shaping up and the effects on the equity market, we have Anand Sharma, fund manager, mutual fund equity at at ICICI Prudential AMC. So, to give a background about Anand, he joined ICICI Prudential AMC in the year 2014, and he is at his current role. He is actively managing. Is the fund manager for ICICI Prudential Housing Opportunity Fund and a co-fund manager for ICICI Prudential PSU Equity Fund and ICICI Prudential Multicap Fund. So, ICICI Prudential PSU Equity Fund is a kind of fund where there has been a lot of action in last 1.5 year. So he carries rich experience, and he understands the market where the action has been since last 1.5 year. I'm sure he'll throw some focus on that as well. So prior to this, he was managing PMS strategy under ICICI Prudential Portfolio Management Services, and he has also covered pharmaceutical, healthcare, metals, mining, sugar. So overall, in short, to summarize, Anand has got experience across the equity market. So he has overall experience of 11 years, and he has been with ICICI since last 9 years. About the qualification, about his studies, he has done his master's in management studies in finance from KG Somaya in Institute of Management Studies and Research, Mumbai. So a warm welcome to you, Anand. I'm sure that
Thank you.
since Q3 results are flowing in, all the participants are eager to hear out from you on what the Indian economy look forwards, and what is the effect on the equity market.
Sure. Thank you so much. First of all, wish you all a very happy New Year. I hope this year is great for everyone, both personally and professionally as well. So very interesting phase of markets, right? So let me just give some context on what I'm going to touch base on. So essentially, the way I'm planning to structure this talk is I'll talk a bit about generally about Indian markets, what's been happening, what are the factors that could potentially go in favor or against Indian equity markets in this calendar year, which is calendar year 2025. What are the potential challenges? And maybe I'll touch base a bit upon some bit of what Q3 earnings has been like, because obviously some large companies have reported, but obviously we also need to be cognizant that more than 60-70% are yet to even start reporting. So just to give a starting point, right? I mean, firstly, if I would have had this conversation with you guys last year, I mean, if we just have a flashback to CY 2024 January, I would have just told you that 2024 is one of those rare years where three of the largest democracies in the world, India, UK, and US, right, go to elections. Obviously, that entire year, the domination as far as topics is concerned was all going to be about elections. To be very honest, UK elections, they never really mattered for India, nor they did in the past, and I don't think in the future also they will matter so much, because apart from a few sectors where we might have some free trade agreements, it doesn't really matter. But apart from that, two major democracies went for elections. Now again, right? I mean, if you look at India, to be very honest, the elections were not that great, right? I mean, all of us, if we just go back a year, we would have thought possibly that the current government will come back with an even better majority. That has not played out. So it's been a coalition government that's in function. In fact, if you just go back to the budget that happened 6 months back, right? I mean, if you would have spoken to a layman, and thankfully all of us are very, very financial literate people, but if you would have shown that budget to a layman, that layman would have asked you whether this is a national budget or this is a state budget of two particular states, right? So it's fascinating how coalition politics sometimes dictates how policies in a country can change, right? So that's been a very fascinating thing. But to be very honest, because of the fact that India was in literally an election season, right from February last year to November, when finally Maharashtra and Jharkhand elections happened. Frankly, there was no work that was happening in this country. To be very honest, all of us speak a lot about capex story in India, right? I mean, that's been one of the interesting themes that equity markets has spoken about in the last 4 years. But to be very honest, in the last 4 years, and the reason why I'm speaking 4 years as a period is, I mean, it's post-COVID phase. To be very honest, it's government of India that has done hard hitting and the heavy lifting as far as capex is concerned. Private sector has not fully participated. In some pockets, of course, they have participated. Whether it is some sectors like steel, where like companies like Tata Steel have put capex in Kalinganagar, or some other sectors, or a sector like cement, for example, right, where instead of putting new capacity, there is in the sector consolidation is happening. So you have Adanis and the Birlas who are left, right, and center acquiring one small company after the other. In fact, every 15 days, all that we hear in the cement sector is some or the other acquisition. So basically, instead of putting new capacity, the private sector there has indulged in consolidation, which also in some form is actually commitment of capital, right? So while an economist might tell you that hey, cement is not putting any kind of capacity, but actually they are actually putting money where it's worth. So still, I would say it is the government of India that has done the heavy lifting in the last 4.5 years. Now, if we just switch our focus globally, right? I mean, US went for elections. Donald Trump was finally elected, and 20th of January, which is Monday, coming Monday, is when he finally takes office. And frankly, I think if all of you all who have been in markets, if you remember the 2016 to 2020 phase, I think all of us used to do just one thing every day. In the morning, we used to get up and we used to look at Twitter. Obviously, Twitter is now X, but in those days when it was Twitter, first thing that we would do is just देखो कि क्या बोला है, कौन से sector को impact करेगा, कौन से stock को impact करेगा. So I think we should definitely brace ourselves for another 4 years. So I think that kind of volatility is definitely going to be there. And if you look at India itself, about 15, 17 days from now, we also have a union budget on February 1st. See, to be very honest, actually, India is one of those few countries where the budget is given so much importance. But yeah, it is what it is, right? I mean, 1 week before the budget and a month or so after the budget, right? I mean, you have all kinds of trades that play in pre-budget trades, budget trades, post-budget analysis, and you will have some stocks and sectors which will collapse. You will have some stocks and sectors which will potentially benefit from the budget. So all those kinds of narratives are also going to shape up over the next 1 month or so. But to be very honest, I think if you look at the last 4.5 years, right? I mean, see, one of the things that just give me one moment. So one of the things, right, that all of us were used to in the last 4.5 years was, whenever companies used to declare quarterly results, one of and we used to focus on CNBC, which obviously gives us real-time updates. Most of the thought process in the last 4.5 years has always been that companies have either reported inline set of numbers or they would have reported above estimates numbers. After a long time, that thesis is now beginning to get challenged. Now, why do I say that? If you look at FY25, and we are now almost 10 months into FY25, and as the discussion started at the beginning, Q3 results have just started flowing in. But if you just look at Q1 and Q2, which have been the full reported quarters till now, frankly speaking, not many sectors have actually delivered fantastic earnings. In fact, if you leave aside a couple of sectors like, say, a pharma, for example, where honestly the money that they have made as an organization and as a sector, most of it has been global, not necessarily Indian. I'm sorry. Uh, a lot of sectors in India have actually now started reporting numbers which have not been meeting estimates. And this, for many people in the markets in the last 4 years, is something new. Because as I said, all that most of us have seen in the last 4.5 years, whether it was an opening up trade that happened, whether it was a pent up buying trade that happened, a lot of it was fantastic earnings growth. Now, when you have a state where companies are delivering fantastic earnings growth, especially if you're a growth investor and growth investing in especially in mid cap and small cap, if a company, for example, is delivering 50% top line growth, 50% bottom line growth, you won't really worry whether you're giving it a 50p or a 40p or a 60p. You'll be like, fine, I mean, it's fine as long as these companies are delivering earnings, it's okay. But it's only when some of these companies start disappointing on earnings is when people start questioning the multiples that you pay to the various sectors. And let me take some examples, right? I mean, if you look at the last 14 years of investment journey in India, and from 2010 to 2024, I mean, I'll keep it till December 2024. Broadly, you can actually divide it into two phases. Now, till 2020, when COVID came specifically, a lot of investing in India had been quality investing. People were not keen on looking at value as a sector. Essentially, it was a B2C investing era that happened. Now, in the last 4 years, value investing obviously took over as a style. Now, today, I think we are at a very interesting cusp where I don't think you can be necessarily married to a particular investment style. All right. I think the last 4 years, frankly speaking, any stock you would have picked, you would have possibly had a 80 to 85% hit rate. Now, generally, in stock picking, that's a very, very high hit rate. And if you look at the track records of some of the greatest fund managers that have existed in the history of mankind, frankly speaking, if anybody has about 55 to 60% hit rate, I mean, they are also considered as great fund managers, provided they have sized their winners. So I think the next 2 years are actually all going to be about stock picking. And frankly, that's where we as fund managers have to actually ensure that we are today are allocators of capital, because obviously we get hard earned money from people. We have to decide where to allocate. So the decision that we make today on where to invest, whether it is large cap, mid cap, small cap, or whether it is investing in micro caps or anything, right? Anywhere, anything, the investing that we make, I think the choices that we make essentially will be very tested, because from here, the game is all going to be about stock picking and sector picking. Let me take some couple of examples to kind of elaborate on this. Again, if I would have spoken to you a year back, I mean, all of us, and since I also manage a PSU fund, we were having a very tough time actually justifying some of the valuations in PSUs, because frankly speaking, we were also not able to understand what's really happening that is driving some of the re-rating in some of these PSU stocks and sectors, and they were the favorite child last year. Today, not many in India want to touch PSU stocks or sectors, right? In fact, last 4 5 months they would possibly be some of the worst performing stocks and sectors. So in India, the narratives can change very very quickly. The other thing that tends to happen during a lot of the extremes is, you tend to see a lot of market cap extremes, for example. Right now, if you look at it, and I'll just show you guys a couple of slides. We basically tried to show how long has the bull market duration been, and this is since the time Indian markets have essentially been in existence. So from a duration perspective, this is obviously now the longest bull market. From an absolute return perspective, obviously we still have some time to go before we match some of the amazing returns that we saw either in the 90s phase or in the 2003 to 2008 phase. But in purely in terms of duration, we are right now at the longest duration in terms of where this bull market is. So that's firstly a very fascinating. Now, why this is fascinating? Because in the past, a lot of bull markets in India, they used to be mostly associated with FIIs investing. Right today, now we have a situation where October, November, FIIs removed more than 1.5 lakh crores. December also obviously has not been great. But today we are in a situation where FIIs are removing money from the country. Obviously, they have put money in US. There is a US trade that is playing in between. There is a China trade that also was getting played. But basically, you have a situation where domestic inflow is very strong, and a lot of the domestic inflow obviously goes in mid cap and small cap, and the FII outflow is getting out from large cap. So you have a situation which has been like a perfect storm for large caps, where people now don't want to do large cap investing anymore. Just to give some more perspective of why I'm talking about mid cap, large cap, small cap as a comparison. Just look at where the valuations are, right? I mean, today Nifty P is 23, mid cap P is 43. Obviously, mid caps are going to be more expensive than Nifty, but if you just look at where we are compared to the historical averages, large cap as a percentage of GDP, we are just 31% higher. Mid cap is double, and small cap is 149%, right? That's the extent of P re-rating that's happening in some of the mid cap and the small cap space. If you look at it today as a percentage of total market cap, and we've taken a data of last 11 years, in 2014, which we would consider as one of the starting points for a 10-year discussion, right? Last top 50 was 62.5%. Today it's down to 46%. So essentially, just look at the massive change that is happening, where just in terms of valuations, uh, the mid cap and small cap space has just gotten phenomenally re-rated, right? But I think today, if you look at it, and again, let me get back to the point of earnings, right? I mean, I'll just spend some time on also what has happened in Q3 so far. To be very honest, it's not been that promising a start for Q3 as well. Specifically, a couple of banks have reported results. They've not been very impressive, right? I think, frankly speaking, till now, the only great reporting that has happened till now is essentially in the life insurance space, and I'll touch a bit more upon that. But I think till now, the earnings that have been reported, frankly, they've not been very impressive. And I don't think one should have a lot of expectations also from Q3 numbers, because frankly speaking, as I said, right, a large part of the economy, even today, from a capex perspective, is still being driven by the government, and government spending has not necessarily happened till November. It's only in December, for example, that government spending has started to pick up. And I think we expect that next 2 3 months, there will definitely be some pickup as far as government capex is concerned. So I think some of those capex related themes or construction related themes, which absolutely hit rock bottom for first 7 months of the financial year, I think some of those should definitely start recovering more. But I think a lot of that recovery we will mostly see in Q4, because Q3 is also a kind of a festive season. There are some parts of India where harsh winter also starts off. So I think from an expectation perspective, the major uptick that you should see, especially as far as the capex story is concerned, is something you should expect in Q4. I think as far as financials are concerned, to be honest, the way the financial industry in India right now is, right. I mean, we have a regulator at the top who is very clear that today the financial institutions in India, whether it is banks or life insurance or be it any other sector, I think the major, I would say, responsibility that the regulator has at this point of time is they want to ensure that there are no mishaps. And I think, to be very honest, I think that's also the way that this government has also been thinking. I mean, just think back to pre-COVID, what happened to the Yes Bank fiasco, and look at the way it was handled, right? I mean, I think it was fantastic the way it was handled, and I think this government kind of prides itself on the fact that they want to ensure that no major accidents or disasters happen. And to that extent, the regulator is going to behave like a hawk. I don't think a lot changes. We will have to see how the new RBI governor is compared to the past. I think it's too early to assess that part. So I think that judgment I will leave it for the next couple of months, because it's not fair to pass judgment on a governor who's just taken office. But I think as far as financial industry is concerned, it's very clear government RBI has tightened a lot. And that's why you see, for example, the loan growth and the deposit growth that are being reported by a lot of the large banks, right? No, forget about mid and small banks. Even the large banks, for example, they've not been great. But this is a tap that can always be loosened. So I think the focus there will be more on something like, say, an asset quality. So I think till now, it's not been too bad. There are areas like MFIs which are kind of problematic in the country. There are financial institutions which are calling out that maybe personal loans could be a problem. See, in the past, the major accidents in the financial industry happened on the corporate side. This time, the corporates are so beautifully deleveraged. I mean, they used COVID beautifully, and this bull market has also been used beautifully by most of the corporates to deleverage. In fact, that's if there is one criticism that we can put on corporate, it's that in spite of deleveraging, where is the next round of big capex that needs to come, right? I think that's a very interesting thing as far as corporates are concerned. So I think this time, whenever the problem happens, obviously some of it is likely to come in the retail segment, for example. And the other part, right? I think, and this is where I think it gets very interesting. I think just look at the IPOs, right? I mean, every second day there is a company that's getting listed. Every few days there are promoters and private equities who are actually selling stakes. And frankly speaking, if I think from their perspective, it's the best thing that they are doing for themselves and their organizations, because you will never get such a liquidity, right? So that's why I said about, it is the responsibility of us as mutual fund managers to decide which of these companies to participate, where to put money, for example, right? Because a lot of times in some of these IPOs, QIPs, they don't tend to leave too much money on the table. So I think that's where our responsibility tends to come in. Again, now, if I just spend some maybe 5 to 10 minutes or so on the sectors that we like as an organization, and obviously some of my personal choices as well, some sectors where we would be slightly worried as an organization. If you ask me, I'll just spend some time on some of the major sectors. If I just look at it, I think the only sector, frankly, where I will make this case that you can actually make money investing in large, mid, and small is probably cement. And I spoke about cement in the beginning, where I said that it's one of those sectors where if you judge by people by the fact that they have not put enough capacity, that won't be the right metric, because they've actually spent money to acquire smaller companies. So it's a beautiful consolidation that's happening in that industry. And typically, when consolidation happens for a long time, the industry doesn't make money. But when the industry then starts making money, because eventually, if somebody is spending 10, 15, 20, 25,000 crores of rupees, eventually they also have to answer questions to their shareholders, right? If you look at the two largest cement kingpins in this country, which is obviously the Adani group and the Birla group, right? I mean, they also are answerable to their shareholders. So there will come a period in the next maybe 1 month, 2 months, 3 months, 6 months. I don't know. I cannot be sure of the timing per se, but I think there will be a point where pricing improves for the industry. And I think, as I said, now that government capex has also kind of resumed, you'll have a beautiful situation in cement as a sector where everyone who is now survivor in the industry, whether it be a large cap, mid cap, small cap, can all make money. No, financials is actually very interesting. In financials, if you ask me, the one sector that we have, see, financials, when I started my career in this industry, financials used to be all about either your banks or you're an NBFC. There was nothing else, right? In the last 5 years, look at how diversified the financial industry itself has become in terms of listed companies. Today, we have AMCs that are listed, we have wealth managers that are listed, we have exchanges that are listed, we have life insurance companies that are listed, we have general insurance companies that are listed. So a lot of pocket of financials. So I will not make a basket case about financials. I'll speak individually about a few of these sectors. I think we are very clear that in financials, the two pockets we like the most today are life insurance and large banks. And when I say banks, it's only going to be large banks, whether it is private or whether it is PSUs. I will not in financials. It is eventually, if you look at, for example, what's happened in a country like US also, right? Financials is an industry which gets consolidated beautifully over a period of time, and it's only the large banks which actually can help to create compounding over 5 to 10 years phases. The small financials, if beyond the point, beyond their regional moats that they have, beyond the find they find time, they find it very difficult to grow. Life insurance today actually very is a very interesting sector, and I'll tell you why it's interesting as a sector. See, all of us would have read enough about what's happening in the industry. Obviously, there is a regulator who is after them. There is a finance minister who has been making a lot of public statements. But in the past, and since all of us have also been associated with the mutual fund industry, the one thing we have always seen is that when you have an industry where a regulator wants to ensure that the product becomes more transparent and more friendly to the customer, you might have short-term pain. That short-term pain could be 6 months, 9 months, 1 year, 2 years. It could be, but over a longer period of time, your margins also might get a little diluted, but the volume growth more than compensates. I think clearly, if you look at what happened in the mutual fund industry in the last 15 years, I'm sure at least a doomsday has been called out for the mutual fund industry at least 5 times. Whether it was entry load, whether it was exit load, whether it was TER, anything, right? But at all points of time, the entire ecosystem has thrived because the product became more and more friendly to the customer. So I think that's exactly what's happening in the life insurance. All of us know that life insurance products have not always been very easy to understand from a customer point of view. I think that attempt is being made by both the finance ministry and regulator. And as soon as some of these teething issues are solved, it's a great opportunity from an investment perspective. On financials, as I said, it's only the large financials at this point of time which look interesting. I'm very clear in saying that, see, financials valuations are cheap. Do I think there is a PE re-rating possible in financials? I think it's very difficult. Frankly, if you look at the entire Indian market today, I think it, apart from some cyclical sectors where you will have PE up downs and uptakes, it's very difficult to call for a PE re-rating. So essentially, the story of Indian markets over the next 2 years is going to be absolute bottom-up stock picking. Any stock, any sector which can deliver reasonable earnings growth over the next 2 years and not give you too many shocks are going to be the ones that are going to be rewarded. And companies which don't deliver all of these are going to be shocked. If you look at examples, right? I mean, if you look at quality investing versus value investing, right? That's one of the great paradoxes, and it's a question that is always asked to everybody, right? Now, some of the great companies in 2019, 2020 who are doing well now, some of them 5 years is zero return, right? Whether you look at FMCG or as a sector, or some of the consumer durable stocks as sectors, right? Practically 5 years zero return. Is the fact that those companies have suddenly become bad? No, it's just not that. It's just that in some of those areas competitive intensity has increased. If you look at paints as a sector, right? I mean, one of the largest company in the paint sector, the market cap itself was so high, right? It was always bound to increase the competition, and that's what we have seen, right? In paints, for example, as a sector. So I think what we will see is that any sector where you see too much competitive intensity, it is likely that earnings growth might not be great. And to that extent, that's the call that we as fund managers have to take, that the balance between valuations versus valuations versus your earnings growth. Because essentially, as I said, it's very difficult for stocks in Indian market today to get re-rated apart from cyclical sectors. The other couple of sectors which we genuinely like at this point of time, obviously, I think power is a sector we continue to like, and it's a very simple thesis, unfortunately. And I say this unfortunately because I think India is definitely in a period of power deficit for the next 2 3 years. I don't think that problem gets solved. So while we are in winter season today, we won't hear too much. But next 3 4 months, when the summer season, for example, starts, you will again have all these newspaper articles saying power shortage in tier 3, tier 4 cities, right? I think that story definitely continues. So power is something we continue to like. Again, there are pockets in power as a sector and energy as a sector which could look expensive, that is definitely there. But I think as a holistic sector, it continues to look pretty interesting. I still think pharma is an interesting sector, but obviously the easy money in pharma is definitely made. So I would not recommend being very overweight on pharma in a very big way. I think you still have enough earnings growth in pharma, but as I said, the easy money in pharma has definitely been made. IT, unfortunately, it's become a trading sector, and it just becomes very, very volatile during result season, because a lot of IT is also driven by positioning, right? I mean, whether mutual funds or investors are overweight or underweight before results, and hence you see some of these vicious and wild moves in some of the IT stocks just before and after the result. And I don't see that pattern to change. But frankly speaking, I think we'll have to wait for how Mr. Trump also behaves after Monday, because there are a lot of things that will be happen, right? Where we don't know which country he targets, how much tariff he puts on which country, what are the kind of various business deals he might strike with various countries. So we don't know all of that. So I think that is something we'll definitely need to wait and watch at this point of time. If you ask me, the beauty of markets is that at all points of time, you always get these extreme market caps, right? If you go back to these 2007, 2008 phase, real estate used to be the king of markets, right? And just look at the market caps of real estate companies in that era. I mean, it was crazy, right? There was a time in 2015, even a great sector like pharmaceuticals, right? I mean, look at the market caps that was there in 2015, right? I mean, the market cap of the largest pharmaceutical company at that point was more than the entire, segment like metals completely, right? So I think today, for example, if you look at a segment like EMS, right? I mean, the stocks are building just phenomenal growth for next 5-10 years. We'll have to see if they can sustain some of those growth patterns for those valuations to sustain. But I think at every point of time in market cycles, you will have some extremities, and that's where the responsibility comes on us. That whenever we see some of these extreme market caps, either I think it's our job to not participate in those market caps at those points of time. So I think EMS is a sector I genuinely worry about, because most of them have just got it listed in the last 3 to 4 years, and I don't think some of them have seen enough of market cycles, and even for us as fund managers to understand how these companies will behave when earnings might not necessarily play out. So I think that's one extreme market cap that kind of worries us. Apart from that, I think generally I would say, because of the fact that we feel that mid caps and small caps are genuinely a bit overvalued, and we genuinely prefer large cap investing. I'm sure you'll hear this from a lot of people, so it's not that I'm the only person who's going to be speaking about this. But I think genuinely this year we should brace ourselves for a lot of volatility. We have seen enough volatility in the last 10-15 days, rather I would say in the last 3 months. I would say November, December, and the 15, 16 days of January have been volatile. And I think you should expect volatility to continue. To that extent, I don't see, at least for the next 5 to 6 months, a lot of those volatility patterns changing, because we have too many events, right? I mean, we have a Trump who is going to come. We have a budget which is going to come. So a lot of enough of news flow that's going to be coming. There's one more point I want to make. And I'll go back to December 2023. And why the reason why I'm going to go back to December 2023 is, if you go back to that era, there were a lot of state elections that were happening in India. And one of the states, right, which is Madhya Pradesh, where we were not sure which way the election is going, one very simple thing happened. The government launched a scheme which has now become very famous, called as Ladli Behna scheme, and that won them the election in that state. And if you look at all the state elections that have happened in the last 5 months, whether it is Maharashtra, Jharkhand, whether it is Haryana, or we all of us have seen and heard enough of what's happening in Delhi, for example, today. And if you look at the next 2 to 3 years, the various states that are going for elections in India, it is Bihar, it is UP, it is Punjab, it is Assam, it is West Bengal, right? So essentially, a lot of these interesting places which have a lot of rural focus as well. So I think, and I say it slightly unfortunately, but there is an aspect of India which is going back to a bit of populism. Historically, populism used to be a very slightly South Indian concept, right? I mean, obviously, Tamil Nadu made it very popular when the chief ministers of Tamil Nadu would generally give a lot of consumer durable items to people of the state, and election mandates would be won or lost. I think a lot of the states in India are unfortunately going to be following that model. Today in India, for example, 1.1% of India's GDP is going in welfare schemes. So now it's not going to stop. I think, in fact, you might probably make a case that it's only going to increase in the next 3-4 years. Now, why is that important, and why did I speak of it? If you look at it, India, for example, the last 12 to 14 years, essentially the story has all been about urbanization. But I think primarily because of the fact that some money is going to be given in the hands of a lot of these tier 3, tier 4 cities, I think what you will see is some bit of recovery in rural part of India. To that extent, some of these rural index sectors, whether it is two wheelers or tractors, I think they can also do reasonably well. Now we'll have to see which ones eventually do better than the others, and also we have an auto expo that's currently going on, so we'll have to see what kind of models, etc., get launched by the auto industry, because essentially auto industry is all about model launches as well. But I think if I look at automobile as a sector, and I said spoke about all this to kind of finally bring it to automobile as a sector, I think this is a year where some of the non-urban pockets can pick up, right? I mean, if some of these rural pockets do well, which is now being also pointed out by a lot of corporates as well, and this is all published data. So I think that's also something that's interesting and we'll have to watch out. And frankly speaking, if there is an improvement, then of course some sectors like FMCG and consumer durables have a scope to recover. But again, right, I mean, all of these sectors have a lot of individual content, tidbits of competition. So we'll have to see how that fares. But just to kind of conclude this, essentially next 1.5 years, in my views, the view is very clear from my end that, and our end as well, that we'll probably stick a bit more of our neck out as far as large cap investing is concerned. People in India don't want to do large cap investing anymore, and I think as more and more mid and small cap companies start to disappoint on earnings, I think people will look out for some safety nets. So I think you will start seeing people migrate to the large caps at some point of time. Frankly speaking, as far as FIIs are concerned, I mean, I don't know how they react. Frankly speaking, they have their own global parameters to work with. So I don't know whether they come back to India, whether they stop their money flow out of India. I don't know. I think that's a very difficult call. But I think definitely the one clear trend is, I think US today is a very overvalued market. I think generally when everybody moves to a particular country to play a trade, that trade does not necessarily play out, right? So today everybody is hoping that Donald Trump might be very favorable for the US economy and the US stock markets, but it's not. Stock markets is all about expectation versus reality, and you make money when expectation reality mismatch is on your side, and you lose money where there is expectation of X and the reality is completely below that, right? I think so. Today we will want to be in areas where the expectation versus reality mismatch is in our favor. So that's where I think large cap investing comes into play, and that's why I spoke about few of the sectors which we like and a few of the sectors which we are slightly worried about at this point of time. But I think I'll conclude by saying the long-term thesis for India stays. But obviously, I think short-term we have to live with volatility, and I think that's basically going to be our duty to ensure that the investors who have not seen any bear market or downsides for 4 years, I think we have to educate them this year that this is a time to stay invested and not run away at the first or second fall. So yeah, I'll open the floor for Q&A.
Sure, sure, Anand. Thank you so much for taking us through this. I'm sure this has been very insightful. Attendees, you can either click on Q&A or you can click on chat and post your questions.
There are a couple of questions in the chat box I can take.
Yeah, Anand, you can.
Yeah, there is a particular stock specific question.
No, no, that we understand. Yeah.
I'll stay away from that. But there is a question that if FIs go away from India, how will our market grow? Even DIS good investment is not favoring our market, and Sensex slash Nifty is showing volatile. See, to be very honest, actually, if you look at it, India has done well in this particular cycle in spite of FIIs and FPIs. not necessarily playing a good part, but I think it's healthy for the country, right? I mean, if you look at the last 4 years, whether it is institutional money, whether it is retail money, or whether it is HNI money, it's all actually supported the Indian ecosystem. Frankly, we don't know how FIIs will react, but I think, see, what is in our hands? Our hands, there is only one thing. As a country, we have to ensure that there is a certain amount of GDP growth. Now there, whether that is 6%, 6.5, 7, debatable, right? I mean, all can have opinions, but I think there is a certain element of economic growth that we need to deliver. We need to ensure that earnings are strong, and we need to ensure major economic shocks do not happen. See, one of the advantages that India has had compared to a lot of other countries, which has helped in India getting re-rated, is we've had political stability as well, right? If you look at other, if I mean, I'll keep US away from this, but if you look at most other emerging markets, there has been a political stability problem, right? Even look at a country like Korea, right? Look at the political upheaval they've gone through. So to that extent, Indian economy continues to do good. See, valuations, idhar udhar, they can go. We are not here to make money in 6 months or 1 year, right? I mean, I think uh, we all just need to stay invested for a long period of time, and there is enough money to be made in India, because economic growth is not a problem. Until now, at least, we've not had major mishaps that have happened. And so I think as a country, we need to focus more on that. There is a question that, is it okay to stay invested in mid and small caps? See, the beauty about India is that India has such a variety and such a large width of stocks and sectors, that for me to say that, don't do mid cap and small cap investing, I don't think that would be right. The only word of caution that I gave was that right now mid and small caps are very, very overvalued, right? But at the same point, if you have a long horizon, right, if you have a 3 year horizon, you have a 5 year horizon, you're willing to ride through the volatility, of course there is no harm in staying invested in mid cap and small caps. The only thing is that I think from an allocation perspective, I think that's something you should look at. If you had X allocation last year in mid and small cap, should you have the same allocation this year? I think that's a question you need to ask. I think I would say this year, probably next 2 years, large cap should dominate the portfolio. But there is no there. I don't think one should ever make a statement in a country like India that बिल्कुल mid and small cap नहीं रखना चाहिए. There is someone who has asked, can you give some overview on the metal sector? See, it's a metals is very interesting because, frankly speaking, the way the metal sector is going, it essentially depends on two countries. One is China, and the other is US. If you ask me, it is the most confusing sector right now, because we all don't know how China is going to react. If you go back a month, there was all kind of articles in newspapers that maybe China is going to give some bazooka or some package. None of it really played out. I think we'll have to slightly see from a valuation perspective, metals looks actually pretty interesting, right? But I think we'll have to wait for some more time before giving a very clear view. I'll be honest, it's a slightly confusing sector, and maybe you'll have to take stock specific calls, right? Because if you look at metals, you have ferrous, non-ferrous, then you have segments like copper, you have iron ore, etc. But I think some of these places like in India, for example, right? I think what happened with some of these places like iron ore, maybe slightly disappointing. But yeah, from a valuation perspective, I would say it's fairly comfortable. There is one question. Can you throw some light on banking and financial sector? I think I spent enough time on banking and financial sector. I would just to reiterate very shortly. I think large private and public sector banks looks okay. I would not venture below that. Life insurance looks fantastic. General insurance is okay. I think MFI is still, I think there is problem. I would avoid MFIs. Small banks, I would kind of not favor small banks as well. And any capital market play, I would definitely be careful, right? Because I think some of these capital market plays are kind of dependent on participation from people in markets. So I think I would be a little careful on capital market plays at this point of time. Then, how will the budget impact the market in long term? Ideally, it should not impact too much, but in the short term, yeah, of course, right? I mean, see, frankly speaking, there are only two questions that people ask before a budget. Whether will the budget be populist or will the budget have capex? These are the frankly two questions, and I think yeah, if you look at this government, it's been now there for this is going to be the 12th year. Frankly speaking, if you look at the previous 10 budgets, and I'm going to keep aside the last 10 budget, there always used to be a discussion on divestment. Unfortunately, we don't know what's happening as far as divestments in India are concerned. So we don't know whether that is something that moves, for example, the PSU sector. We don't know. But I think that there are two key questions: whether the government is going to be populist in the budget, whether they want to give some tax benefits, etc. We don't know. I mean, I read as much as you read in the newspaper, so we don't know. And the second part is capex, right? I think those are the two things. Either side, they will. I mean, you'll will. I think we'll have to just look at the budget when it is announced. It's too difficult to call how they would be going as far as. But of course, right? It impacts the budget, and if you look at every year's budget, the one sector which has typically gotten bashed the most on the budget is mostly life insurance, right? I mean, it's one sector, as I said, but I think with incrementally with every passing year, the products are becoming more and more friendly. So, yeah, maybe budget impacts that sector as well, but we'll have to see. Um,
We have one question that is it the right time for the new investor to get in the market? So to answer that, I think SIP is the best mode through which a new investor can start investing in the market.
Definitely.
And I'm sure that this will help you to handle the volatility that will continue, say, probably for next 6 to 8 months, as Anand has said.
Yeah, and I think just to take one more point, right? I mean, today, if you ask me, I think since somebody had also asked about mid cap and small cap investing, I think the better way to do mid cap and small cap investing is probably through flexi cap and multi cap funds, right? Because they will also have some element of mid cap and small cap investing. So either ways, when like if you look at, I mean, I might have some amount of prejudice. I'm a multi cap fund manager, but I think one of the beauties of multi cap categories is that. It forces you to have some amount of mid cap small cap, and to that extent you're forced to look at the best ideas in the country. So I think that's the way I would look at mid cap and small cap investing today. Then there is someone who has asked about green energy. I'll just speak on the question. How do you look at green energy portfolio in the next 4 5 years period from today compared to oil and gas markets? So these are obviously two different sectors. But okay, so let me speak a minute each on each of the sectors. So I think if I look at oil and gas as a sector, see, first and foremost, we need to remember that if you look at oil and gas, we are not the price setter of the commodity, right? I mean, the price setter is somebody sitting in the Middle East and obviously Russia and US, right? So we are not the price setters. Obviously, what happens to a price of oil ultimately determines in oil and gas, for example, if price of oil goes up, your upstream does well. If price of oil comes down, then your downstream does well. So I think oil and gas to that extent, it will definitely stay volatile. What we have also seen in the last 2.5 years is geopolitical issues, which have also caused wild spikes in oil prices. But if there is anything positive that happens on geopolitical crisis resolution, right? We've been hearing a lot in the last 3 days about some kind of settlement in Israel. We don't know if eventually someday if some settlement happens between Russia and Ukraine as well, and if oil prices were to settle. Firstly, it's good for the country, right? I mean, because as a country, we are a net importer of oil. So to that extent, if oil prices are at a lower level, it's great for the country in the first sense. The other point, and I it's not a part of the question, but I wanted to also touch base upon this. I think what you are also observing right now is a bit of currency depreciation that's happening. It's obviously helped the IT sector, but I think you should also brace yourselves that this is one of those calendar years where possibly there is a chance that currency even depreciates further. There is a chance. I mean, you can't be sure. Obviously, the we'll have to see how RBI etc. reacts, because forex is obviously something they will control. But I think this is one of those years where exporters can actually benefit, right? Whether it is IT, pharma, automobile, right? Even on the metal side, whatever exports we have. So I think exporters might have a reasonably good at least 4 to 6 months. There is something on the green energy. See, frankly speaking, Again, I'll split this question into two parts. There is something on green energy adoption in the country. There is no doubt that next 5 years, a lot of green energy adoption is going to happen. Now, does that mean that stocks will also necessarily do well? We'll have to see, because a lot of green energy stocks have gotten listed. Some of them have gotten fantastic valuations. So for them to continue to get those kind of valuations, they'll have to deliver numbers. Right. So at this point of time, while there is no doubt about the adoption of green energy, I think some valuations in some of these pockets in green energy is leaving slight amount of discomfort, I would say. We have more questions.
And then I think due to proximity of the time, I think we can take the last question.
So
So
I think somebody has asked about automobile sector. I'll just take that.
sure.
I have 5 minutes. I mean, if you guys have, that's not a problem.
I think we have, I also see two, three attendees posting question on defense and railway. So if you can touch,
Oh, please, that's my favorite question. I will answer that for sure.
sure.
Okay. So as it, because I also manage a PSU fund, I've answered so many questions on these. Frankly speaking, I would see if you look at defense and railway, we'll have see what happens is that if you look at what's happened in defense and railways, essentially all both of these sectors have done well. Whenever there has been a press release that defense companies have gotten ABCD crores worth of order inflow, stocks have done well. We don't, the earnings will come at some point in the next 3 4 years. Unfortunately, both the sectors have captured in the valuations too much, and it's become a favorite sector of everyone. The the propensity to disappoint in these sectors, in spite of the fact that both of these sectors have corrected, defense more so. I think there is a valuation challenge. At the same time, defense as a country, do we have a choice but to spend on defense? Absolutely no choice. As a world, we are no more in that great globalization phase. Every country in this world today, even a strong country like Germany today, has had to spend money on defense. So I think as a country, we will have to spend money on defense. But I think because of the fact that this is such a narrow theme, the valuations have just gone berserk, and we still see that there is a problem in defense and railway sectors when it comes to valuation. But again, we'll have to keep the theme and the valuation separate. And equity markets, unfortunately, what happens is that even before the theme has played out, sometimes the valuation captures everything. And unfortunately, most people come at the end when there is no juice left in the theme. So I would urge you to be very careful in sectors like defense and railways. That's one definitely. In fact, genuinely, I would say today, for example, I think I would say private has more margin of safety generally, right? I mean, than some of these PSU sectors. Somebody has asked about automobiles, so I'll just cover that as the last question. So, automobile, I think, as I said, two wheelers is probably looking a very promising sector because we expect that there could be some recovery in rural. And if you just think of what's happened in two wheelers, we have not yet reached the volumes that we sold in 2019. So it's practically 6 years of negative volume growth. I don't think that can continue. There will be some growth in rural pockets. So to that extent, sectors like two wheelers and tractors can do well. I think four wheelers, if you look at it, the story of India in the last 4 years essentially has been an SUV story. I'm sure all of you will understand this. At some point of time, the entry level cars have to pick up. For that, obviously, the economic growth needs to also slightly more pick up. Some job creation needs to happen a bit more better. And obviously, rural also helps. I think you might see a entry level car also slightly picking up over the next 3 to 4 years. I think the problem in autos is essentially all the export sector segments, which are essentially focused on places like Europe. I think there is a slight challenge, I would say. So that might take some time to fix. But I think two wheelers and four wheelers look far safer bets than some of these auto ancillary companies. Just one point. I think one point we need to also just keep in mind. See, last 4 years, I think if you look at it, real estate has seen a fantastic growth, right? But some of it has also been fueled by stock markets, right? So I think at some point of time, if stock markets also slightly take a breather, we'll need to be slightly cagey and careful of what happens in real estate, especially in places like North India, where some of the real estate demand tends to be investor driven rather than pure demand. Pure demand India में फर्क नहीं पड़ता है. I mean, वो अच्छा टाइम हो बुरा टाइम हो, people who have to buy houses will buy houses. But some of places like North India, where थोड़ा सा 30-40% tends to be investor driven, some of that can also slightly die down.
I think, and we have one more.
Yeah, yeah, I'll take, absolutely, I'll take.
So, views on gold and silver, if you want to take it or.
Oh, see, obviously, I would say I mean, there was a chart that came out, right? That gold has actually delivered better returns than Nifty for a very long period of time. My personal view is they do deserve some part in people's portfolio. I think some of the movements in gold and silver could also be driven by what happens geopolitically and globally, because in times of crisis, for example, I don't know, firstly, whether there is a crisis or not, but in times of volatility and times of crisis, sometimes people jump into gold and silver. So I think they deserve a place in people's portfolio for sure. Now the extent, now considering that gold has done so well, would you keep the same weightage as you kept last year? May not necessarily be true, but I think they both definitely deserve a place in your portfolio.
I think so. This is the last question, and so before we conclude the this call, thank you so much for touch basing on all these sectors and sharing the insights. I'm sure that our investors are going to benefit out of this session. And
Sure.
we conclude this call, Anand. Your last comment on it, and then
Sure.
probably we
I
can.
will. Yeah. Firstly, thank you so much for giving me time. And let me make one disclosure. There was, in my entire call, none of it was intended to any names that I might have taken. They were not stock recommendations at all. My only purpose was to speak on sectors which we are bullish on and sectors which we feel could be challenging. I think I'll conclude by saying this, that next 6 months they will be volatile, but I don't think I always say this, life is not a bed of roses, right? I mean, what goes up has to always come down slightly. So I don't think we should be necessarily worried about that. I think it's our job as fund managers to ensure that firstly, we allocate capital in a judicious way to ensure that investors have a reasonable investing experience over a long period of time, because obviously wealth is never made in 1 year or 2 years. It's always made over a longer period of time. So I think the theme for this year and next year, in my view, right, and I'm taking the liberty of possibly even talking of 26, I think large cap investing looks to be the theme. But as I said, I will never make a statement that in India you should not do mid cap, small cap investing. India is a country of bottom stock picking, so we will have a mix as well. But I think large caps will definitely dominate our published portfolio. Whatever is published, you can see that as well, right? Frankly speaking, I don't know when FIIs, FPIs come back. I don't have an answer to that question. It's tricky. I think only they know, or possibly even they don't. But I think as far as India economic growth, economic story is concerned, I think we are on the right track. Valuations are a slight concern, but that's okay, right? I mean, all you need is a bit of absolute and time correction, and you'll have enough stocks and sectors at reasonable valuation. So yeah, that's the message. But I think large cap investing is a critical message for this year and next year, in my view.
Thank you, Anand. Thank you for taking out the time. Thank you.
Sure.
Yeah, with this, we conclude the call.
Yeah, and I think all of us need to be clued in on 20th as to what happens finally when Mr. Donald Trump comes into power.
Right.
A lot of the statements that I make today, right? We don't know how they will play out after he comes into power.
Yeah.
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 Okay. Thank you so much.